the investment of the funds. The banks invest their surplus funds into three types of the securities: the government securities, the government approved securities, and the other securities. The government securities are the securities which are issued by the central or the state government, such as treasury bills, national saving certificates, etc. Other approved securities mean the securities which are approved under the provisions of the Banking Regulation Act 1949. And these includes the securities of the state associated bodies like electricity boards, housing boards, debentures of the land development banks, units of UTI, shares of regional rural banks, etc. Other than these, the banks also are authorized to invest in other securities. That is, the securities issued by the corporates. Now let us come to the agency functions of the bank. These are the functions which the bank perform in return to the commissions. That is, the bank charge the commission for performing these functions. The agency functions include transfer of the funds, that is, transferring the funds from one place to another. For example, by preparing the demand drafts, mail transfer, telegraphic transfers, etc. Collecting the funds from the customers, such as through checks, demand drafts, bills, hundies, etc. Purchase and the sale of the shares and securities on behalf of the customer, that is, by providing the investment banking facility. Collection of the dividend and interest on shares and debenture on behalf of the customers, and acting as the executors or the trustee of the bills. Bank also create the provision of the income tax consultancy and provide the income tax consultancy and accept the income tax payments on behalf of the customers. Banks act as the correspondent, agents, or representative of the customer, as well as securing documentation for the A, R, and C packages. Besides this, the other functions performed by the banks include purchase and sale of foreign exchange, issuance of the traveler check and the gift check, safe custody of the valuable goods in lockers, underwriting activities. Now the commercial bank can be categorized into two forms: the scheduled commercial banks and the non-scheduled commercial banks. The scheduled commercial banks are those banks which are licensed under the Schedule 2 of Reserve Bank of India Act. In India, we have three types of scheduled commercial banks: the public sector banks, the private sector banks, and the foreign banks. The public sector banks can be further categorized into two parts: State Bank of India and its associates, and other nationalized banks. Private sector banks are of further two types: the old private sector banks and the new private sector banks. New private sector banks are those banks which were formed after the liberalization policy of the government. Now let us move on to the central bank. What is the central bank? The central bank is the apex institute of the country's monetary system. All the commercial banks operate under the central bank. Central bank have a wide range of responsibilities, from overseeing monetary policy to implementing the specific goals such as currency stability, lowering down the rate of inflation, and full employment. Central bank also generally issues currency notes, function as a bank to the government, regulate the credit system, oversee the commercial bank, manage the exchange reserves, and act as a lender of the last resort. The examples of the central bank include, like in Australia, the Reserve Bank is the Central Bank of Australia. In Japan, it is the Bank of Japan. In UK, it is the Bank of England. In US, it is the Federal Reserve System. In India, the Central Bank of India is known as the Reserve Bank of India. Now let us look into the functions of the central bank. The first and the foremost function performed by the central bank is the currency authorization. It is only the central bank which has the sole authority to issue the currency in the country. All the currencies issued by the central bank is its monetary liability. It means that the central bank is under obligation to back the currency issued by the assets of the equal amount. And the assets consist of gold coins, gold bullion, foreign securities, and the domestic government's local currency securities. The country's central government is usually authorized to borrow money from the central bank. The government does this by selling the local currency securities to the central bank. The effect of this is that there is an increase in the supply of the money in the economy. Next function performed by the central bank is the banker to the government. The bank acts as a banker to the government, both to the central government as well as to the state government. It carries all the banking activities of the government, and the government keeps its cash balances on the current account with the central bank. As the banker to the government, the central bank accepts the receipts and make the payments for the government, carry out the exchange, remittances, and other banking operation. It provides short-term credit to the government and also has the responsibility of managing the public debt. It also advises the government on the banking and the financial matters. Next function is the banker's bank and supervisor. As the banker to the bank, the central bank hold a part of the cash reserves of the bank because banks are required to meet the CRR requirement, that is the cash reserve ratio requirement, and they are authorized to keep their cash with the central bank. The central bank also lends the commercial banks for the short-term funds. They provide them with the centralized clearing and remittance facilities. The banks are required to deposit a stipulate. The pool of the funds with the central bank serve as a resource from which it can make advances to the banks for the temporarily purpose as and when they require, thus acting in the capacity as the lender of the last resort. The central bank supervises, regulates, and controls the commercial banks by regulating their licenses, branch expansion, liquidity of the assets, management, amalgamation, and the mergers and liquidation. The control is exercised by the periodical inspection of the banks and returns filed by them. Central bank, in the role as a control of the money supply and credit, takes the recourse of various instruments, generally in the category as quantitative and the qualitative instrument. Now let us discuss what are the quantitative instruments. The quantitative instrument includes bank rate policy. The bank rate is the rate at which the central bank lends its funds and act as a lender of the last resort to the banks against approved securities or eligible bills of exchange. An increase in the bank rate increases the cost of the borrowings from the central bank, and this reduces the ability of the banks to create the credit. On the other hand, a rise in the bank rate will cause the banks to increase the rates at which they will be lending. This will then discourage the businessmen and the others from taking the loans from the banks and thus reducing the volume of credit in the economy. Similarly, a decrease in the bank rate will have the opposite effect. But in actual practices, however, the effectiveness of the bank rate policy will depend upon number one, the degree of the bank's dependence on the borrower's reserve, the sensitivity of the bank's demand for the borrowed funds to the differential between the bank's lending rate and their borrowing rate, the extent to which the other rates of interest are flowing in the market, and lastly, the state of supply and the demand of the funds from other sources. The third important control measure is the open market operations. Open market operation means the buying and selling of the government securities by the central bank from or to the public and the banks. And successful conduct of open market operation as a tool of monetary policy requires that a well-functioning security market should exist. Other than these control measures, the next measure is the variable reserve requirement. The variable reserve requirement are of two types, the cash reserve ratio and the statutory liquidity ratio. Under the cash reserve ratio, the banks have three options: to maintain the cash with them, to deposit the cash with Reserve Bank of India, and to deposit the cash with other banks. And the banks have to keep a certain percentage which is set as CRR by the Reserve Bank of India. Under CRR, the banks are required to maintain a certain percentage of their net demand and time liability, as we have discussed earlier. CRR is a tool of monetary and credit control. An increase in CRR affects the cash dispersals by the banks. SLR, the statutory liquidity ratio, is the ratio which the commercial banks are required to maintain either in the government securities or in the government approved securities. Like CRR, the increase in SLR also controls the money supply in the economy. Now let us move on to the qualitative credit control tools. Qualitative credit control tools include the imposing of margin requirements on the secured loan. Now suppose the margin is 40%, which is set by the central bank. Then the banks are allowed to loan up to 60% of the value of the security. By altering the margin requirement, the central bank can alter the amount of the loan made against a specific security by the banks. This type of control measures are useful when the central bank attempts to control a specific purpose lending. The high margin requirements discourage the speculative activities with the bank credit and therefore diverts the resources from the unproductive and speculative activities to the productive investments. By reducing the speculative activities, there is a reduction in the fluctuation of the prices. The next measure is the moral suasion. This is the combination of the persuasion and the pressure that the central bank applies on other banks in order to get them to fall in the line of its policy. This is exercised through discussions, letters, speeches, and hints to the bank. The central bank frequently announces its policy position and urges the banks to fall in the line. Moral suasion can be used both as the quantitative and the qualitative credit control measure. Other than this, the central bank can also impose the selective credit controls. These can be applied in both a positive as well as the negative manner. Application in the positive manner would mean using the measure to channel the credit to a particular sector, usually the priority sector. And application in the negative manner would mean using the measure to restrict the flow of credit to the particular sector. So students, here we have learned about how the money is actually evaluated and what are the roles and the functions of commercial banking and the central banking in the economy. Thank you.